Many W-2 taxpayers feel like they cannot use the tax code to reduce their own taxes, but that is absolutely false. And that is why in this video, I'm going to show you the top 5 ways to reduce your taxes when you have W-2 income. So when you earn W-2 income, you can reduce your taxes by carefully and strategically making investments that not only increases your wealth, but also reduces your taxes at the same time. So as a licensed CPA that tax plans every day at mycpacoach.com, I am going to reveal to you my tax reduction matrix that I personally use to consistently save my W-2 clients thousands of dollars in taxes every year. So let's jump right in. All right, so let's start off with a very easy one here. Number 1, deferring your income. Now, I like to think of this as pushing income off of your tax return this year and reporting it at some point in the future when ideally you may be in a lower tax bracket. So look, the more income you earn, the higher your tax bracket will be, and the more taxes you will pay on certain portions of your income. But when we defer some of that income, we can immediately reduce our taxes. So for example, let's say a portion of your income is taxed at 35%, and we'll just use $100,000 of income here for simplicity. Well, if you did absolutely nothing, then you would pay $35,000 in taxes on that portion of your income. But if you deferred that income, you would immediately save $35,000 in taxes. And let's say in the future, you withdraw portions of this income when maybe it's taxed at 12%, for instance, which means that when all is said and done here, you would only pay $12,000 on taxes on that same amount of income, saving you a net of $23,000. So in order for you to defer income and save money in taxes when all is said and done, you must fully understand your income and how it is being taxed now and how it may be taxed in the future. But with that said, you're probably wondering, well, how exactly do I defer my income? Well, you can easily defer your income with various retirement plans, health plans, and even deferred compensation plans. So as far as retirement plans go, you could set up a traditional IRA on your own and defer up to $7,000 to $8,000 depending on your age and income. And if your employer offers a 401k plan, for instance, then you could also defer about $23,000 to $31,000 as an employee of that company. And if you happen to have a side business or a side 1099 gig, you may also be able to defer another $46,000 or so through the use of something like a solo 401k or SEP IRA as an employer. But that's just retirement. You can also set up a health savings account or HSA and deduct up to $4,000 to $8,500 of income you place into it if you qualify. But outside of tax advantage accounts like these, I have also seen my W-2 client set up deferred compensation plans with their employer, which is basically just an arrangement with your employer where they agree to pay portions of your compensation at a later date. Some employers will even go as far as offering you stock options or equity compensation as mechanisms to allow you to defer tax to a later date. So if you're looking to reduce your taxes as a W-2 employee, all of these things should be explored. And this is just level 1. So let's go ahead and take it a step further here. Method number 2, real estate investing. So I have several clients that are able to reduce their W-2 taxes to almost nothing by investing their income into rental properties. And that is because when you buy rental properties, you benefit from a few different things here. Like number 1, depreciation. This is a non-cash expense that the tax code allows you to deduct on your tax return. And in some cases, people are able to depreciate up to 20% of their property values in one given year. So if you bought a $400,000 rental property, you could potentially depreciate $80,000 of that amount and use that to reduce income on your tax return to pay less taxes. That's if you meet certain criteria. And that's just the beginning here. The second benefit is number 2, no capital gains when you sell the property. That is, if you use a technique called a 1031 exchange, which basically allows you to avoid capital gains tax when you sell a property if you buy another qualifying property within a specified amount of time. And number 3, let's not forget that you are buying an appreciating asset. Buying real estate is not an expense, it is an asset. So you are trading one asset, your cash, for another asset, property, and equity usually. So unlike spending money on an expensive car that loses its value as soon as you drive it off the lot, real estate usually appreciates in value and can preserve your capital. And then there's my personal favorite, number 4, real estate cash flows. Real estate is one of the only investments where you can profit from rental income in reality, but show a paper loss on your tax return for tax purposes. But to do this correctly, you do need to understand several tax strategies and concepts, like the short-term rental strategy, the real estate professional tax status, cost segregation, and so much more. So just drop a comment below if you want to learn more about those concepts. But the purpose of this video is to expose you to the various ways that you can reduce your taxes. So let's keep going here with number 3, business investing. So just like you can buy real estate, you can also buy a business to receive big tax benefits, or simply invest into an existing business, or even start a side business. So let's break this down a little bit here, starting with buying a business. So just like you can depreciate real estate assets, when you buy the assets of a business, you can also depreciate those assets on your tax return and use it to reduce your income. For example, let's say you bought a dry cleaning business for $100,000 to simplify this. And let's say that business has washers, dryers, property, and other equipment worth $75,000. Well, in that case, you can elect to use Section 179 depreciation, which is a tax provision that may allow you to write off 100% of those assets in 1 year, basically granting you with a $75,000 deduction that you can then use to reduce your taxes. Alternatively, you can invest into an existing business as a partner, and that investment can also be tax deductible when that business incurs expenses related to your investment. For instance, if your investment is being allocated to things like additional advertising expenses, or the development of a new product or service, or for any expense really, those expenses are usually 100% tax deductible if they have a valid business purpose, which may greatly benefit you from a tax perspective. And then finally, you may even decide to start your own business, even if it's just a side business or small side gig where you earn 1099 income. And this can benefit you greatly because when you run your own business, you are able to write off more of your expenses, and usually things that you may already be paying for. For example, when you have a business, you may be able to write off portions of your home expenses, car expenses, meals at restaurants, travel expenses, healthcare, and in some cases, even childcare or education expenses with the right structure. Again, there is some nuance to correctly doing these things, but my goal here is to expose you to how you can use the tax code to your benefit here while keeping your W-2 job. So let's move on to the next example in our matrix here. Number 4, oil and gas investing. So as a CPA, I have clients that make these types of investments and are able to write off up to 90% of what they invest in one given year. And the great thing is that they are able to invest passively and then use their investment deductions to reduce active W-2 income on their tax return. So let's talk about how exactly this works. So first of all, you have to understand that increasing domestic oil and gas production is a major priority of the US government. And since they can't do this themselves, they provide very big tax breaks to companies that conduct drilling operations to increase this type of production. Which means if you invest into these types of companies, you get to participate in those very same tax benefits. Now, the type of investments we are talking about here are not on the stock market or on a public exchange. These are usually private companies that accept investments from people who qualify as accredited investors. And if you do, you will be able to benefit from a number of tax breaks available to these companies, like depletion, depreciation, and the unique ability to write off intangible costs related to drilling, and so much more. So if you want to learn more about this, I do have a separate video on our channel already that goes into much more detail. So make sure you subscribe and check that out to learn more. Which brings us to the 5th part of our matrix here to reduce taxes on W-2 income. Number 5, charitable investing and giving strategies. So there are actually several creative ways to use charities to reduce your taxes significantly. As a CPA, I have had W-2 clients set up their own nonprofits to reduce their taxes, set up private foundations to reduce their taxes, set up donor advised funds, or simply donate appreciated property to a nonprofit organization of their choice. And the tax benefits of doing this is quite simple. The tax law allows you to deduct donations you make if you use the itemized tax deduction on your tax return. And if you set up your own nonprofit organization or qualified giving fund, if you will, you can basically create charitable tax deductions by moving money to another entity structure that you still control. For example, let's say you usually give about $10,000 to nonprofit organizations each year, which could even be your church, but you want to find a way to save more money in taxes, and let's say you have some extra capital on the side. Well, since you already give $10,000 each year, well, what if you just created a qualified nonprofit fund and moved, let's say, $50,000 to it? That way, you would be able to realize a larger charitable tax deduction in that year and still give the same $10,000 to nonprofits of your choice from that fund like you already do. The only difference is that you're realizing the tax benefits sooner. And you can do this with your own nonprofits, private foundations, or setting up something like a donor advised fund, for example. Now, another thing that I have seen people do is donate appreciated property to nonprofits. And this is big because when you donate property to a nonprofit, whether it's stocks, equipment, real estate, or whatever the case may be, the donation is usually valued at its fair market value, not the cost that you paid for the property. So for instance, let's say you paid $1,000 for property that you ended up donating to a charity, but when you donated it, it was worth $10,000. Well, that would mean that you would be able to write off the $10,000 value of that donation, not the $1,000 cost you paid for it. And you would be surprised, but there are a lot of ways you can be creative with this. I once had a client who set up his own nonprofit, bought Section 8 rental properties, and donated those properties to his own nonprofit to save massive amount of money in taxes. And that's just one creative example. But with this tax reduction matrix, there are endless possibilities of what you can do to reduce your taxes while keeping your W-2 job. So if you want to learn more about this, make sure you subscribe to our channel at a minimum. And if you need immediate assistance with reducing your taxes right now, just apply to become a client of mine today at mycpacoach.com.